All right, we can start. I guess everybody's on a holiday today. So we'll do a little bit of thank you all first for participating and joining us. Yes, today is a holiday in the United States. So we're all kind of relaxed today for the session. But one of the things that I want to basically share with you, the importance of having a clear picture of what to do when you get to the market, or having the ability to decide on your course of action. Trading, guys, has changed a lot. It has changed. Trading did not change, but people have changed the way they trade. People believe that now that the more complicated it is, the more difficult it is, the more let's say the more complicated it is, the more you're able or you're supposed to make money. They don't feel that taking a good trade and making money in a short period of time with a simple reason, with a simple logic, with a simple common sense, that is really true, or that trading has to go back to its basics. And for example, the way we trade is that planning for us, our trades, is essential. It is key. It is a work ethic. If you do not have a trade plan of how you're going to approach the market, there is no way. I mean, especially in today's market, it is extremely hard to actually be consistently making money. The key is to have a well-defined plan on how you're going to trade. Some of you have been complaining, or I read some of the blogs the other day about the volatility that happened in the euro dollar last week, and that there was a lot of chopping and people lost a lot of money because everybody was short the euro, and they were assuming that short should be continue, and nobody expected any reversal or any turnaround in the euro. If you look at this of any chart, before I go to the euro to discuss the euro, I want you to look at this chart, and I want you to make a very common sense, a very simplistic, if you want to describe this chart to a 5-year-old, and you're trying to describe to him the price movement, the simplest way that you can describe it to him is that this thing is moving from here, going up till here, but while it is traveling this journey, it is zigzagging. It's going up a little bit and it's coming back a little bit, but if the general direction is to the upside, then it makes a big move in the direction of the trend, and a small move in the counter trend or in the opposite direction. Big push, a small pullback, a big push, and a small pullback. That is the way the price movement. This is the most guaranteed thing, the most sure thing that you can. I mean, there are 3 things that you can be guaranteed, or you know for a fact. 1, that you're going to pay taxes. 2, that we are not immortals. Okay? So, like they say in the state, death and taxes, they are the 100% guaranteed. The third thing that is guaranteed is that the price chart doesn't move in a straight line. This is like you and I breathing. We take a deep breath up and we exhale. We inhale and we exhale. We inhale and we exhale. That is natural. So if that's the case, we can expect a move in one direction or in the direction of the trend and a pullback in the opposite direction. The danger is, and that is and I'm not talking about you, and I'm talking about the ones that give the advice. They delve the advice and start pouring it out. They tell you the euro is down and you should be bearish the euro and you should sell the euro. Fine. We should be doing that. But the euro, even though it is moving down, there has to come a time, in a move like this, there has to come a time where it kind of pauses and just bounces back into the opposite direction. And we need to define a price point. A price point like this, where we can say, if we look at this chart and the prices is coming down, and you see this, you always, when you're looking at a price chart, guys, forget indicators, forget moving averages, forget all that stuff. That stuff is finished. It doesn't work. This is ancient. C'est fini. Over. You need to be an expert in price. You need to be an expert in price behavior. And the simplest way to do that is to always be asking yourself, where will this market change direction? I am now short this market and I am going down and I'm staying short. Where, and you every day you have to ask this question, where will this thing turn around and behave in a normal way? It has been inhaling, where will it exhale? You cannot inhale all day long. You have to exhale. Otherwise you will not survive. You inhale, big move, exhale. So this thing is coming down. You always have to ask yourself where it is going to turn around. And this is what we do every Sunday in our trade planning session. It is to identify the price points where the market is going to change direction, and we identify where the market is going to continue. What is the price reference that tells us that am I continuing in the same direction or am I reversing? And on this day here, I mean, this is the, and I will show you the recording that we had this, not yesterday, but the week before, and a few of guys were with us yesterday in the session. The buy point over here on that day, we were looking at this thing to continue because it broke the momentum low. So I'm looking for capitulation. I am looking for the downward trend in the euro to continue. And we were short the euro and we were short the euro pound. And then it turned around and it came right there. You see this little green thing? It came from the structure point, which is 129.67, and it broke to the second structure point, which is below it, which is the 128.87. And rather than capitulating, it stopped and I had a positive day. Well, the rule based on price behavior is if you break a structural point, you have not to just grind your way down. You need to capitulate. You need to give me an extensive move. Why? Because a structural point is a point that has been identified, utilized, and used by the majority of the professional traders. They are using it. They're using it for a reference point. They're using it as buy signals. They're using it as sell signals. They're using it to place their stops. They're using it either a buy stop or a sell stop. It is a serious decision-making point. And if it is a decision-making point, then I use this point to identify the decision of the market. I am looking at the 128.87. I'm looking at the 1.88. I'm going to type it for you. 87. That number to identify the market's decision. I am trying to identify the market's decision. I want the market to tell me how it is going to behave. So when the price trade below 188, 1.2887, the rule is that decision should be down, an extensive move to the downside. If I get a move like this and it doesn't go down, then the market has made a decision. That is a ruling. I am Mike. I am not going down. I have broken through the 128.87 and there was no sell stops underneath it. There was no sell orders below it. There was nobody intending to sell that market. On the contrary, having this green candle is nothing more than tells me that actually the buying has actually, rather than they want to sell it, they are actually buying. And for us now, this is all the information that you and I need. We as traders, guys, I want to share a small point with you. Can anybody in this room listening to me right now can tell me with any certainty what is he going to have for dinner tonight? Can anybody predict what exact time he's going to sit and have dinner? Can anybody do that? Okay, you're a brilliant guy. You're one. Absolutely. I mean, if you want to be joking, Rob, that's fine. But in reality, guys, nobody can predict precisely to the minute what is he going to do at just as something as simple as what time he's going to have dinner or what is he going to have dinner. And if I cannot predict something as simple or as trifle as what or when am I going to have for dinner, how in heaven's name can anybody predict what's going to happen to the euro next day? Once a trader plays the game of predicting the future, that is a losing game. It is not a game that any successful trader plays, because you have no odds in succeeding. But a successful trader, what he does, he anticipates the move. There is a big difference between predicting the move and anticipating the move. And that is the difference between a trader and an amateur. An amateur, anybody that can tell you, I have predicted that this fib is going to go up to 66.235, whatever that number is. This is somebody praying God. He can be lucky once, but he cannot pay the rent every single month with it. Predicting is an amateur's game. Predicting is a novice game. Anticipating is a professional's game. Because when you anticipate, you are not putting Nicholas, I cannot speak about anybody. I can talk about myself. They are all professionals and they know how to do it. I'm talking about myself. Okay? And let's have a decorum in this forum. That's my 5 cents worth. Take it for whatever it is at face value, and you can try what you like to try and come to your own conclusions. Okay? I cannot. Okay? But this is what I'm going to tell you, Nicholas. I'm going to show you how we do it. And again, we do this anticipation process every Sunday, and I will show you in a second. But let me finish this price point, and then I'm going to answer this question. So the anticipation, Nicholas, is this. If it trades below 129.67, I anticipate it will go to 188, and therefore I will short. But this anticipation, what it does, and having that clarity, Nicholas, what it does, it gives me several things. One, it gives me direction of a trade. Okay. Two, it gives me my risk or my stop, if you will. Three, it gives me the possibility of reverse. Okay? So I'm going to show you those 3 things. How do we do that? And you will see how we're using this simple well, it's good. It's a starting point. If you're not bad anticipating, then a little bit of training will make your managing a little bit better. So that's why trading is not something that you can learn from a book. Trading is a process. It's a skill, like playing golf. You cannot go take a golf lesson for 4 days and you expect that you can go play championship golf tournament. You have to stand. Well, okay, Nicholas, I understand. So the idea is that you learn the methodology, and then by the correct application, and we all make mistakes. We all make by more and more practicing the same set of rules. You see, if I want to. I will come to this point in a second. Let me give you the 3 points that we identified: the direction, the risk, and the possibility of a reversal. And then I'm going to tell you about consistency. Okay? And you will see how simple trading is. Guys, every time I go to one of the banks or the hedge funds that I train, the first slide that I put on the screen is this: trading is not E equals MC square. Trading is not the Einstein, that doesn't require the Einstein theory of relativity. Trading is very simple, but it's not easy. If you accept the simplicity, then it will become easy. So let's go on. So now here, guys, let's say you with me, we decided that we are going, and these arrows are, we are decided to go short below, we're going to go short below 128.87. Okay? That is our short. And that 128, if you see it on my screen in a light blue color, if you see it on my screen in front of you in a light blue color, dashed color, that identifies a point that is what we call a structural point or a significant point. This means that that is a point of a high hierarchy, and it is a point that should generate a major magnitude, a movement, or a move with a big magnitude. Okay? That any time you see a light blue color, that's what it means. And my expectation for this trade is to get a big move. All right? Now, why are we going short below 128? I told you this is a structural point. So the question is, why are we going short below 128? The answer is extremely simple, Nicholas, because it is trading below 1.28870. That's the only reason we're taking the trade. I have a price point that's 128.87. If the price trade below the 128.87, that is a structural point, and that is the reason I took the trade. Okay? So let us say I took the trade, the prices came and traded below 128.87, and I sold it, let's say, this is what we train you on, guys. We sold it at, one second, let me finish the point, Manish. We sold it at 1.28, let's say 60. So my trigger is 128.87. I got filled at 128.60. Okay? So what is now, how many points I am down now? I am already now, I sold it at 128.60. Where will I go out of this trade? Now I sold it at 128.60. Where will I go out of this trade? No, that if it's going in my direction, Manish, I will take profits over there. I will take profits over there. Okay? No, forget the 2-to-1 ratio. This is all, we don't trade like that. Our risk-reward ratio is, if not 5-to-1, it is actually 6 or 8-to-1. So, the rule is, the reason that if we take a significant point or an origin entry, that's exactly the, I sold it because the reason was it traded, forget my original fill, what price that I got filled, but I sold it, my reason to short it is 128.87. So if the price turn around and get back above the 128.87, then the reason that I got in, brilliant, and brilliant, brilliant, the reason has gone. So what happens now is that my precise entry point, what it has done, thank you, you are brilliant. That's you don't know how long it takes me to explain this. Brilliant. So what happens is, just by identifying the reason to get into the trade and from where you get filled, what this does, it gives you that your stop now is equal to, in this case, 10 pips. That is your stop. So you're risking 10 pips technically on that trade. I mean, you need to give it a little bit more room than that, but technically that is your stop, because you have identified your entry based on a reason. I did not take my entry because I had divergence. I did not take my entry because this is the slope is going up or the slope is coming down. I took it because precisely it is trading below the 128.87. There is no ambiguity, there is no subjectivity, there is no opinion, there is no I could have, should have, would have, and I've taken that trade. No, this is as clear and as precise as you can simply get. I'm getting there. Hold on, training. So now, what happens now, you have identified your risk. First, we did by identifying the point, we identified the direction we want to go short below it. Second, from the moment I get filled to the price that, if the prices go back above my selling point, that becomes my stop or my risk. So now we're risking 10 pips, 15 pips, whatever the number is. And then what? So now I took the trade and I'm short, and now it comes back and it goes back above the 128, and let's say the high of the day over here. It went to 129.30 or something, 129.60. Okay, now it tells me I am not going down. I got stopped of the trade at a loss. So what should we do, guys, right there? This is one structural point. This is another structural point. Now it is in the middle of nowhere. So we do the opposite, because the beauty of the chart, the magnificence of the chart, exactly, Ralph, the magnificence of the chart, the elegance of the chart, and the typical normal behavior is people act the same way if the market is going up, and people act the same way if the market is coming down. People behave in the same way. Exactly. So this means if it gets above 129, which is the other structural point, we are going to buy it above 129.67. And guys, I mean, some of you are with us in the room. This is what I'm sharing with you. This is an actual trade with real live money that a couple of hedge fund guys that are with us, and I'm not talking small traders, I'm talking big hedge fund guys with us in the trading room from the Sunday session, took this exact trade that I'm describing to you, exactly like that. And they bought it right above, and that when we do the radar screen, they bought it at 129.67. That was our buying point from last Sunday. As I said, every Sunday we do these trade planning sessions, and we plan our trades. And so our buy entry, not yesterday, but last Sunday, was we're going to buy the euro right above 129.67. And take a look. That day, because it has failed to go down, reversed and went up, it went all the way up. We had 200 pips on that day. And then you have another structural point here, which is the 133. No, you haven't seen anything yet. This is, I kid you not, I mean, there are some of you guys here in the room with us. This is an actual live trade, and I'm going to show you exactly the trades, and I'm going to show you the money that was made. So right here, you have now, it came above the structural point with speed. Where do you think it's going to go? Where do you anticipate the next move? You look at where the blue lines are on the chart, and that should be here. This is where you anticipate the next move to be, because the price moves exactly 133.37. No, 133.37, right there first, here. That's the first. And then it should go to the one, if it goes to the 133.37, before it goes to 134, it should again behave in the same way, the opposite that I was describing on the way down. So take a look. That's the next day. Right to the 133.37, and it stopped. And then the third day, right to the 134, to the penny, turned around, and it came down, and this is where we are today. Without any prediction, no God, this is a 600 pip move in 1 week. 600 pip. Now, let me show you how we do that, and how we plan our trades, and how important for you to plan the trades. Planning your trades, people think I will tell you 1 second, Jack. Let's have fun, and no. This has to be your work ethic. I have been for 32 years, unless I am on a vacation or sick, every Sunday I sit before the next morning, before come Monday morning, and I plan my trade. I used to write them on a piece of paper. I used to write books, manuals, buy above this point and go short below this point, and I draw this line and I draw this thing. But now, in the old days when I started, there was trading 10, 15 different instruments, even though it was not that much, but it was really cumbersome. So now what we have decided, the way we do it now, every Sunday, I want you to take a look at this for a second. You see here we have what we say the long point, the short point, the structural long, and the structural short. And we have the stop on our long positions, and we have the stop on our short positions. And we cover in that session, these are all the instruments that we cover. So for example, today, this is from yesterday. Now, if you see the color white, this means that hasn't been triggered. So today, the 82.87 is white. That's in the dollar yen. So we're not long, but the blue, the short is red. It has changed its color. So now I should be short the dollar yen below 82.50. And if you go here like this, I'm now short. I should be short now the dollar yen, and you are 2 pips in the money. If you look at the Aussie yen, you're short from 82.70 today, and it is now trading at 82.14. You're up 60 pips. The euro pound we shorted this morning at 84. It is now trading at 83.58. You got another 50 pips or 42 pips there. The Euro Aussie, you went short at 134.08. It is now 133. You got 60. So all what I'm trying to say, I mean, you can do your math. I'm not doing this to promote. All what I'm doing is when you have that kind of specificity of identifying these points and having them on your radar screen like this, the moment one of those changes color, if the green, for example, look at the pound dollar. The pound dollar, it is 158.83. We bought it this morning at 158.83. It's a no-brainer. We don't think. Above 158.83, then the high probability is to the upside. You buy it, it is now trading 159.12. You're up 25 pips. The pound CAD, the pound Swiss, the pound Aussie. All these, we set and plan every Sunday, and they work all the week. And all what you have to do is to take one of these numbers as a reference point and make your trading decision. If the pound dollar is above 158.83, then you're going to buy it. Where is your stop? If it gets below 158.83. But this is what we have it, and when we do it on Sunday, for example, I'll show you, we're buying it at 158.83. Our stop was 158.40, and that in this case we're risking 43 pips, and so on. And that's when you do take everything. Now you come Monday morning, you are prepared, knowing exactly which way you're going to be taking the trade. Okay, so let me answer the questions in a second. Okay, let me show you the trades in the euro. Hold on a second. I will show you, Manish. I'll tell you how we do it. I mean, this is it's beyond. I mean, this is something we do. Where are you? I mean, that's basically primary, but I will show you. I'll give you a little bit of an explanation. Now, I want you to look at the screen. Thank you, Lord. Take a look, guys. Thank you, Lord. Look at this. This is one trade. This is on this was on the 12th. You took it at 129.80. And look at this. These are the two trades from 129 to 131. These are blue lines, so they are winning trades. And then the next session you took them again. There is the winning trade, and so on. How do we get to these levels? Okay, getting to these levels, I am not trying to keep it a secret, nor I don't believe that this is something that should be kept secret. I believe, and I have it. I mean, this is a dream of mine that everybody that's approaching the market to learn how to do this. It's a passion, but I want you to understand that this is stuff that I teach in 6 days or 5 days. Plus, there is a lot of rules to identify every single one FX Hive, and I don't want you to take something to hurt yourself, okay? Especially because we're all open. So the way we do that, the simple way that you do that is that you look at the chart and you're trying to identify, the major, the most observable. This is one of the rules. Significant. I'll give you an example. And this is how we trade. For example, one of the major significant points in, this is the euro, so I don't want you to think that I am looking at the euro. I'm going to give you how we trade. These numbers, guys, these structural points, these numbers, everybody that trade with us using price behavior knows these numbers by heart. You can be sitting on the beach and you can ask, where is the pound dollar? And if I tell you that, for example, the pound dollar is above 157.06, what is it? 1.5706. Okay, that is a structural point in the pound dollar a couple of days ago, and the next one is 159.80. So if I tell you, you tell me a week ago, last week, I asked you, where is the pound dollar? You say it's coming down, it came up now, and it's trading above 157.06. I'll pick up the phone and tell the broker, buy. And put your stop below 157.06. And my target to get out is the 159.80. Now take a look. And not just, I'll show you, before I go to the other one, the dollar yen. The first number is 81.12, and the second one is 82.87. So I'll buy it from 81.12, and my next target is the 82.87, and the next one is the 84. Now let's and you just know these numbers, and they never change. They never change because these are units of price behavior. These are units that, as many as the market wants to stop me, keep in mind that your stop is very small, Master FX, and you're risking 5 or 10 or 20 pips, which is nothing. But once it goes, I mean, we never ever take a trade 2-to-1. We never take a trade 3-to-1. The average risk reward on any of our trades, based on the significant point, at a minimum 5 to 6-to-1, and sometimes it goes as high as 10-to-1. And if there is whipsaw, there is whipsaw. I'll give you another example, Master Effects, about the whipsaw. The whipsaw in the pound Swiss, okay, the number is 169.45, and I'm going to show you. I'm going to put 45 here. 1.6945. Okay, that is the number in the pound Swiss, and I'll show you. I don't care. I can get stopped out 10 times. Not literally, but if it gets 2-3 times, I'm going to stop, and I'm just going to wait until it confirms the direction. But still, above 169.45 for the pound Swiss, I'm a buyer. Below 159.45, I'm a seller. So let's do this quickly. Let's go first to the pound dollar. And there you go. That is your 157.06. So right there, if you're looking at this, it comes up 157.06. You're going to be a buyer. Your next target is the 159.80. And right there from 157.06, you're already now up 200 pips. Thank you very much. Let's take the dollar yen. Well, I have to show you. I have to show you. I mean, it's not something that you can do in a half an hour base. You'll hurt yourself. So the easy way for you, instead of knowing how, is at least come and copy them. Come and see which the numbers are, copy them, test them, and find out at least how to use them. But if I tell you now how to process something in an hour, you're going to hurt yourself. I'm not hiding it. On the contrary, why do you think we do the Sunday session for $15? You think it's worth 2 hours of my time? With just the webinars and stuff like that, this is what the cost of it. But we want you to come in and to be successful and to make the money. So come in, copy them, because we leave it out. couple of times, learn how it's done and take it, but at least you have a correct, you don't want to do something by mistake. Believe that, for example, if you, any line on the chart you can put like this, I can put a line right there, 87.91, you can do that by mistake, and then suddenly you believe that this is the point, you go in and buy it and it doesn't work, and then you say, no, this thing doesn't work. I'd rather if you can just take the number itself, and this is how we train the traders. If you be patient with me for a second. So for example, look at this, the pound, the dollar, yen. Remember, 81.12. Okay? And the other one is the 82.85, and then the third is the 84.40. And this is how we identify. I'm more than happy this to tell you. Trust me. I'm more than happy to give you. It's because this is where the market has decided. We don't calculate. I don't calculate anything, Bill. I don't. All what you see on my chart is what the market is said, the typical behavior, highly on. It's only the charts. Okay? So if the market says 84.12, it's 84.12. If it's 84.69, I'll show. That's what it is. I basically do not think what I'm trading. I don't have an opinion. I don't predict the market. I don't want to do anything. All what I want is to the market to tell me, and exactly, yes, training trader, yes, or trying trader. Okay? Now, let me show you, now when you talk about whipsaws, let me show you the pound Swiss, and you will see the whipsaw. Remember, the number is 169.45. Okay? You see this 169.45, guys? See this number over here? Bill, it's not a precise science. If you want to take it at 84.12 and I took it at 84.20, it doesn't really matter that much. So as long as you know that above 84.12 you want to be long, and below 84 you want to, I will tell you about the euro, Jack. Let me finish this. We have a lot of time. We have another 45 minutes. Okay? So I will. Now I want you to look at the pound Swiss. Look how many times 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. 12 times. It goes up, I buy it. It comes down, I sell it. Even though my losses have been small, but once I was on the right side, it took me from 169.45 all the way down to 161.80. I lost, let's say, 6 times 20 pips, but once I caught the big move, I made 600 or 700 pips. And that's what trading is all about. All right? The room, John, if you're in the UK, you can come here to the office. We'll show you the training room, but you can log in. The training room, the trading room that we have is after you get trained, because everybody in the room is okay. I'm happy that is actually trading live. I'm happy that you got it there. Okay, now with that, let's go to the euro and decide which way. Some of you guys are asking where would the euro go. Again, I'm not predicting the direction. What I'm going to do is I'm going to share with you how we can anticipate the next move. It's on Sunday. Mike will put for you the link to the Sunday session. Kim or Mike put the link for John. So anyway, so now we're looking at the way we do this, guys. Now we're looking at the euro dollar. And we're trying to decide now where would the euro be. All what I can tell you right now is at this moment in time, I am short. No, you would buy the dollar bill, or I mean, because the rules of FX Street, I should not give anybody trading advice, and I respect that. I will buy the euro above 133.87. Okay? If it does not, right now, I am short the euro. And my reference point is the 133.87. So now I'm short and I'm trading. I am not interested in going long the euro. If it gets above the 133.37, then it should go up towards the 137.46. I think most of you remember we were doing a webinar probably I think back in March or April 2010, and we decided we're going to go short below the 137, and that was the move we took. So now if it gets above this, it is going to go back and test. There are several things, Master. There is basically highs, lows, turning point, typical behavior before and after the move, magnitude, and all they are stuff that you can visually identify. And as I said, it is simple. The question is, you practice it so that you can develop the confidence, so that you do not bring your opinion into the game. So the more you practice it, the more you use it. Like Leo, for example, I mean, he's just started with us in the room, the trading room, a couple of weeks ago, I would presume. And he's now methodological. He takes it. I mean, like yesterday, he said he copies the picture of the radar screen on his Mac, and he's already sharing it with the other guys on Facebook. And I'm really happy about that. So these are the price points. And now he took today, according to him, he took a trade today and he made 60 pips. That's fantastic. That is brilliant. And I'm so proud of him, and I'm so happy that he is able to do that. And that's what you guys have to do. Now, Jack is asking, sorry, did you say yes? Yes, I would be buying the euro dollar above the 133.37. And this is how I do it, guys. Look at my intraday chart. This is my intraday chart. Even before we spoke, look at the blue line. What is the blue line? 133.37. And right there, this is my buying point. I don't have to think. If the prices get above the 133.37, bingo, click the buy button and we're done. Exactly, it was there an hour ago, but that wasn't a buy. Even, let's say, assume that you took it. Okay, you bought it at 133.37 and it came back, you lost 10 pips. What's the big deal? Another important point, Jack, I want to share with you, and I want to share it with all of you guys. Do you think if it goes above 133.37 and it comes back down, I would be hurt, or I'd be say, oh, I was wrong on that trade? Honestly speaking, would you think I would say that? Come on, guys, all of you. That's for all of you. If I said above 133.37, I'm going to buy it, and it breaks down, and it goes above 133.37, I buy it, and then it turns around and it comes down, will I be say, oh, I made a mistake? You know why, Leon? Of course, I would never say that. Again, it goes back. Thank you, Alex. Thank you, Alex. That is what trading is all about. You do not, if you are predicting, if I am predicting that it is going to go up, if I am saying I predict it is going to go up and then it comes down, then I was wrong and I won't be able to take the next trade. But if I am anticipating, then the market didn't behave as per my expectation, so now I can get from it a different information to the original direction and I can take the trade. Once you guys predict, that's why I was telling you the difference between a professional and amateur is the word predicting and finding a target. This is my target. Once you do that, you're predicting. So now at that moment in time, all what you care about is to be right. But I don't care about being right because I'm not predicting. So I don't care to be right. What I care about is to be rich. Who gives a hell if I was right and I predicted this and that and I don't have a dime to show? We're not in this business to brag. You're not coming here spending your Monday or your holiday or your day so that one can sit with the other and to brag. You're here to make money. So in order to make money, you may have to make sure that it doesn't make you're doing it the right way. Okay? Now, the tick chart and the time chart. Let me give you the explanation, the difference between the tick chart and the time chart. If you have a defined time of 10 minutes, I could have 1 or 2 trades with a big order coming in, and Kareem is doing well, thank you very much. Somebody is asking me about my son. Yeah, he's doing well, thank you very much. The time chart, I'm telling you, I mean, I have to explain to everybody, Master Effect, so that everybody knows what I'm talking about. So it's not, so I need to put a foundation first. If you take a 10-minute bar, and let's say it has a range like this. Let's say, assume that this is a 10-minute bar. Boom, it goes up. This could be 1 trade, could be 2 trades, could be 1 big order, a market order that came in and it's triggering all the stops on the way up and triggering all the stops on the way down. And you have a big range candle, but in reality, in its core, it's empty. It's a spike. Right? But the way we do here, the way we set that, we're taking, a tick is a trade. A tick is a trade. So we're taking the last 200 trades, whatever they are, whatever the prices of the last 200 trades are, and putting them in a price bar. Now that 200 tick, if the price is going up, then there is 200 buy orders that took the prices up, or there are 200 sell orders that took the price down. So the 200 tick is, from our testing, is synonymous to about 15 to 20 minutes of a regular candle, and that is a reasonable. You don't want to have 1,000 trades or 1,000 tick bar. It's going to be too condensed, and you don't want too small a bar. You want it to be too tight. The idea about trading, guys, is always having something in an average. You don't want the perfect number. Some people will say, I'm going to optimize my system so I can get the perfect moving average that works for this, or the perfect that. That doesn't work. You want something that does this. I'm going to write it so you don't forget it. Something that gives you the statistical edge. Okay? All right. So, okay. Bill in England is asking, if I buy at 33.37 and it moves up 10 pips, do you sell short if it breaks back? No. No. You don't do that stop and reverse, Bill. Okay? If it goes up 133 like this, for example, here, this doesn't mean I took it short over here. No. Absolutely not. I would take it short over here. Okay? You don't want to be whipsawed. If it doesn't get, I mean, why do you, Jack? If it doesn't get to 133.37 and it's in the middle of nowhere, why do you want to bother with the euro dollar? Why don't? This is why, again, we do the Sunday session. What is the most important thing for you as a trader to have? In order to become successful trader, what you need 5 things. Anybody can tell me what are the 5 things that you need? No. You need 5 things. Any suggestion, guys? Okay, that's 1 per selection. Huge account perfect, Paul Volcker. I love your name, by the way. Oh, okay. I mean, okay. All right, hold on. Okay, Jack, we'll discuss what you have. Okay. Now, what you need, guys, first is this. The number 1 you need, I'm going to tell you, Jack, in a minute. Hold on a sec. What you need is a methodology. A way. Now, discipline, consistency, money management, all that stuff is good, but you cannot do every single time, or discipline even. Okay? Like, no, hold on a second, I'll tell you. The first thing, you need a methodology. You need to be like a surgeon. You need to be like a surgeon. Okay? A methodology. So anytime a surgeon goes in and does appendectomy, irrespective of the patient, he does it the same way. Every single time. This is how he's trained to perform the appendectomy. Second, you need what we call portfolio selection. Which pair should I buy today? Should I buy the euro dollar, the euro yen, or the dollar yen, whatever it is? What should I buy today? Okay, that's the second thing. 3, you need what we call timely entry. You need to be in the trade at the best possible time. Not the perfect time, but the best possible time. 4, you need to get out of the trade, exit the trade at the best possible exit, so that you can maximize your profit. Last but not least is that you need the support of either a group, a peer group, or a trading desk, or somebody that follows the same rules that you are following, so that they can keep you on the right and narrow, and they can hold your hand. So somebody of you is saying, be consistent, okay? Money management, risk. You cannot have Manish profit target. Profit target is wrong, because you're predicting the future. When you put the word target, it's wrong. You're playing God. Okay? So 9 times out of 10 you will be wrong. You will be lucky once or twice, but you will be wrong. Okay? So, how to be consistent? How can you, let's look at chart like this. I'm going to come down I'm not going to forget you, Jack. I'm going to do it for you. So let's say I'm putting let's put a chart like this. Okay, and I'm going to put some moving averages, and I'm going to put some MACDs, and I'm going to put some lovely stuff, stochastics, and I'm going to put all moving averages, 3 moving averages, lovely, okay. Now, and if you want to put another stochastic on top of it, which for an RSI, and if you want to put now take a look at this. Take a look at this. Here, for example, you have a sell signal. Right there. Right here, you have a buy signal. Right here, you have another sell signal. Here you have a sell, here you have a buy, here you have a buy, here you have a sell. How can you... I mean, maybe you can decipher it and read it. But the question, the point that I'm trying to make is, how can you be consistent? How can you be consistent? There's no way in heaven. There is no way in heaven you can be consistent. So if I'm preaching the gospel to you and I say you have to be consistent, I have to show you how to be consistent. This is no way on heaven, on God's earth, that any trader can be consistent or to do the same thing twice. It's a practical impossibility. But guys, if I do this is the euro dollar, and this is going to lead me in doing for you the thing. If I do this and I put a line here at 133.37, okay, I wish I can. We have 5 minutes left to go. This is, you can go to the, I mean, I teach them. I'm not hiding them, Leona. You asked me a million times. I'm more than happy. That's why I'm giving it. I'm giving it. Help yourself. Now, if you look at the 133.37, and I tell you, guys, look at this. Below 133.37, just go short. Above 133.37, now it comes to 133 here. The rule is above 133.37, then you go long. If it didn't go up, then you don't want to go long. You have no trade, you go short again. Right here it goes above 133.37. Now you're going to go long. Can you be consistent? That's it. That's the epitome of consistency. If you don't do that, then you're not consistent. That is, and I'm not, Dathan or Leon, it's not there is no way that I can teach you that in half an hour. Plus, what about the stops? Okay, the stops is you can place your stop on the other side of your entry point. Okay, you can place your stop on the other side of the entry point and give it a cushion. Okay, so I guess we're timed out. Okay, Vicky, thank you all very much. I'll be back next month. Yeah. Oh yes, give me 1 second. So you're long at 132. Just put your stop right there. Don't let it go below 80. Don't let it go below the 80. If it goes below the 80, close your trade. Okay? Thank you guys very much. Hope to see you. Happy New Year. Hi, Kamal. Happy New Year. God bless you all, guys. Happy New Year.